The UK economy continues to suffer the effects of inflation. As of the time of recording, the most recent data for January showed consumer prices at the headline, including food and fuel that is, 10.5%, far outstripping recent wages data, which itself was relatively strong, which means that consumers are increasingly finding it difficult to spread their income across the demands of a typical household. With the Bank of England raising interest rates in an effort to drive down that inflation number back down to its target rate of 2%, mortgages, one of the biggest components of many households, are rising at an alarming rate. We're talking now to Andrew Wishart, a senior economist who runs the UK Housing Service at Capital Economics. Andrew, great to be able to catch up with you again. Thanks indeed for your time. A very busy man at the moment. Of course, clearly we're talking about a sector here that everybody's talking about. What's your main takeaway of what's happening and the dynamics within the housing sector?
Yeah, I think obviously, we still think that the Bank of England isn't finished quite yet with its hiking cycle, and that means that although mortgage rates have come down a bit since the peaks they reached after the mini budget, we don't really see them declining much further. And now, with mortgage rates now around 5% compared to below 2% a year ago, that means that the cost of borrowing a mortgage is still extremely high by historical standards. We've seen that pass through to a big collapse in demand. And obviously, we've seen mortgage approvals slump back to levels similar to in the financial crisis, actually, in December. So I think, we're seeing very weak demand, and now we're starting to see, we've already seen prices drop back by 4%. But I think when you look at the cost of buying with a mortgage right now, it's still very high by historical standards. And that means that prices are going to have to fall further to get the market moving again.
Of course, one of the interesting things about house prices at the moment, people talk about this drop that we've seen, and we get this evidence across the board from the RICS, from the Nationwide, from the Halifax. But of course, when you take in the fact that we've got inflation at 10%, that means against pricing, house prices have actually come down quite a long way. Do you see house prices continuing to fall? If so, by what sort of margin? And how do you measure the house price drop?
Yeah, so there's a couple of points there. I think, firstly, we are expecting a continued fall in house prices. So we've had 4% so far. We're expecting another 8% fall by the end of the year. But it's a very good point you make on inflation outpacing, inflation obviously positive while house prices are falling. So the real fall is already the magnitude about 10%. And I think in real terms, we're probably looking at a 20% drop in house prices to sort of revalue them for a higher mortgage rate environment. So, I think it's actually something that will cushion the nominal fall in house prices is the strong wage growth we're seeing. But ultimately, the biggest driver is that huge rise in mortgage rates, which means that people simply can't afford to borrow as much and therefore bid as much for homes. And that's why I think we're seeing prices falling, and we will continue to throughout the rest of this year, I think.
What's your view on interest rates overall? I asked the question in the context of whether or not people are now choosing to go back to variable rates, because that means then if the Bank of England does start to cut rates, they want to take part in that. They don't want to set a very high level of mortgage rate payments or mortgage repayments. What is the feeling at the moment in terms of what the consumers are doing and their preferred way of paying back a mortgage?
So there was a period where fixed rates were much higher than variable rates for a few months at the back end of last year, and that did see a slight shift towards tracker mortgages. But the UK mortgage market is dominated by fixes, and in particular the 5-year fix, and that now is back. The market is pricing in rate cuts further ahead, so the 5-year swap rate is lower than bank rate now, and therefore I think that short-term shift to trackers is unlikely to continue because they're pretty similarly priced. But you're right also to say that if our bank rate forecast is right and you wanted to gamble on that, a tracker probably would be the cheapest option over 5 years. But yeah, no one really knows where bank rate is going, even the MPC themselves, of course.
Absolutely. I mean, we could be here debating that all day. Let's move on to take a look at what the effect of all this is having on the rental market, because this is obviously, here in the UK, it's a massive market still, despite the fact that people are being tempted to sell down because of all sorts of other pressures being brought to bear by governmental intervention as much as anything. But what's the mortgage like the rental market like, and at the moment, is it still buoyant in your mind?
Yeah, very buoyant actually. I think one effect of higher mortgage rates is that and stretched buying affordability is that people that would have been first time buyers choose to rent instead, and they tend to be sort of financially quite well off compared to most renters. So that's adding to demand in the rental market on top of strong nominal pay growth. And also, particularly in cities, there seems to be a bit of a lack of supply because people tended to move into smaller households, so effectively taking bedrooms off the market during COVID at good rates. And that effectively means there's less supply when people are returning to cities. So all of that has seen very strong tenant demand. And then on the supply side, obviously you mentioned policy, but also the fact that a lot of landlords that do have buy-to-let mortgages are on interest-only mortgages. They're likely to get squeezed quite hard as they come to refinance over the next year. So supply dropping off at the same time all really points to continued strong rental growth.
Okay, so a bit more crystal ball watching. How do you see 2023 developing, given the fact that we're not yet done from the Bank of England, and given the fact that people who are on these mortgages that are going to mature over this year will have to face higher rates of payment and so forth? What's the big risk this year, do you see, for the housing market, given the current environment?
I mean, I think there's sort of two big risks. I guess one would be that it all stems really from base rate. I think that staying higher or going higher and staying higher for longer is going to mean that more of the correction in house prices, more in the housing market in terms of affordability, has to come through a fall in house prices rather than declining mortgage rates. So that that would just would increase the scale of the correction we're expecting. And then I think the other one is we're all the received wisdom is which we're very relaxed about forced selling and because of the sort of affordability tests we've had in place. And I think and how well capitalized banks are now compared to the financial crisis. But I think there is a pocket of risk in buy-to-let lending. I think a lot of landlords are going to end up seeing their mortgage payment outstrip their rental income, who have higher LTV. So I think that would be the two sort of key risks to see.
In that situation where you do get the elevated risk levels, do you think the government will then come back in? And we're hearing a lot from commentators about what the government's done in the past, and it has bolstered house prices, I guess, to some degree, about certain policies that try and help people get on the housing market. We've seen evidence that it's lifted prices. Do you see the government getting involved again, or do you think they've grown wise to this now and are looking at ways to try and extricate government help for people to buy houses? What's the government situation with regard the housing market?
Yeah, we've definitely seen a sort of pullback from some of the schemes that sort of helped to buy ending, obviously, and not much. I don't think there's going to be any, or certainly haven't heard anything about a replacement of that. So it does feel like the government's taking a step back from the sort of helping home ownership policies. And I guess it'll be interesting to see if there's anything in the budget, but I think there could be a bit of a, ultimately these things are a political economy question. And I guess with the election coming up fairly soon, there could be, and I suppose people who are on 2-year fixes refinancing in particular are going to be hit by the sort of change in interest rates. So, potentially there could be something around that at some point. But not sure.
We'll have to see. And I guess we'll be back with you as and when it does happen. But Andrew, in the meantime, look, thanks indeed for your time.
Thank you very much.
That's Andrew Wishart, a senior economist who runs the UK housing service at Capital Economics.